Good morning, good afternoon, good evening, depending on where you are in the world. Welcome to the financial statement series at the Peterson Institute for International Economics. I'm Nicolas Véron, and it's my pleasure to welcome our two guests, John Cunliffe and Dan Tarullo, for this session on macroprudential policy and whether there are already lessons for macroprudential policy from the COVID-19 crisis. As usual, this is a team effort. I want to thank everybody at the Peterson Institute in the events teams, meetings, database, IT, communications for their support, and especially thanking our speakers for what I think is a very topical issue. Macroprudential is a big word, which sounds like a lot of jargon. It's actually a simple idea, which is that when thinking about financial regulation and the prudential regulation of the financial sector and financial firms, it's not enough to look at individual firms at a given point of time. You have to look at the sector as a whole and take a holistic approach. And there are no better qualified speakers to discuss this today than John Cunliffe and Dan Tarullo. I'll introduce them briefly. John Cunliffe, of course, is the Deputy Governor for Financial Stability at the Bank of England. He's been there since late 2013. He studied at Manchester University, lectured at the University of Western Ontario in Canada, and he's had a very distinguished and very full government career. He entered the UK government service in 1980, initially at the Department of Environment and Transport. In 2005, he became the second permanent secretary at Her Majesty's Treasury. And in 2007, the advisor for international economic affairs and the European Union to the Prime Minister, who at the time was Gordon Brown. He then became even more committed to matters of European Union as the permanent representative of the United Kingdom and to the European Union in Brussels for almost 2 years in 2012, 2013, after which he joined the Bank of England in his current capacity. He's had to do a lot, I have to mention that, with the Brexit planning, which to avoid Brexit having any detrimental impact on financial stability, both in the UK and globally. And he's also been a member of the steering committee of the Financial Stability Board for a number of years and involved in many global debates in that capacity and other capacities of representing the Bank of England. Dan Tarullo studied at Georgetown, at Duke University, at the University of Michigan Law School, and joined the US government service in the late 1970s, initially at the Department of Justice and the Antitrust Division. He also taught at Harvard Law School, practiced law in Washington, D.C. for a time, and served in the staff of Senator Edward Kennedy. In the Clinton administration, he was Deputy Assistant to the President for Economic Policies and Assistant to the President for International Economic Policy in the Executive Office of the President at the White House, also member of the National Economic Council, of the National Security Council. For several years, he was at the State Department as Assistant Secretary of State for Economic and Business Affairs. So it's difficult to think of a more distinguished public service career in the US government in this kind of area. He's also worked and published in several think tanks, the Council on Foreign Relations, the Center for American Progress, and of course, the Peterson Institute for International Economics, where in 2008, if my memory is correct, he published a book on Basel standards, at the time Basel II. And I have to say that the analysis of this book has aged very well, including the analysis of the weaknesses of the Basel II Accord in the light, with hindsight, of the great financial crisis in the late 2000s. Of course, he joined the Federal Reserve immediately after the inauguration of Barack Obama in January 2009, and he served 8 years there, resigning in February with effect in April 2017, since which he's taught at Harvard. Dan is also on the advisory committee of Transparency International and in a number of other nonprofit and advocacy engagements. Enough for introduction. John, over to you.
Thank you very much, Nicolas. So I want to talk today about what we've learned and what we are likely to learn from the COVID crisis about financial stability and macroprudential policy. And first, what do I mean by financial stability? And I have to say, as the Deputy Governor for Financial Stability, I'm often asked to define it. And I envy my colleagues on the monetary policy side in that respect. But for me, financial stability, first and foremost, is about ensuring that the financial system does not amplify economic shocks, and if possible, that it serves to dampen them. In other words, that the system as a whole doesn't make things worse, and if possible, makes them better. And a very important part of that is ensuring the financial system doesn't cause the shock in the first place, as it did 10 years ago. But as we're seeing now, the shock can originate from outside the financial system. And in those cases, it's just as important to ensure that the financial system doesn't amplify it. When economic prospects change sharply and there is a radical increase in uncertainty about the future, the danger, as we saw 10 years ago, is that the financial system can overshoot and go into fear mode. And the resulting breakdown in the supply of credit and financial services to the real economy makes the recession worse, which in turn worsens the shock to the financial sector, which then further increases the dynamics of fear. The reforms of the last 10 years have been designed not just to prevent the system creating another great financial crisis, but also to give it the resilience to enable it to avoid an overshoot of risk aversion. So how well have we done, and what are we likely to learn in the future? Well, on the first question, the short answer is that the banking system in the UK and other advanced economies has so far come through the crisis pretty well. It had the capital strength to absorb a large initial surge in credit as corporates cooled down on their credit facilities in February and March. It had the resilience to provide the forbearance to households through payment holidays and to weather the sharp increase in risk and in prospective impairments without contracting the supply of credit to the economy. Other post-crisis reforms have ensured that bank liquidity and counterparty credit risks have not destabilized the system in the way they did 10 years ago. On the non-bank financial system, the picture is less encouraging. The economic shock of COVID led initially to a flight to safety, which rapidly became a sharp and hugely destabilizing dash for cash, in which even safe assets were in danger of spiraling into fire sale dynamics. It took massive central bank intervention to halt these dynamics and to restore order. And going back to my definition of financial stability, to prevent this part of the financial system making the crisis worse. Well, the Financial Stability Board, along with national authorities, is now conducting a review of that for the G20 to ascertain the lessons we can learn and what action is necessary and whether we need more resilience in non-bank finance and how it should be achieved. That's not my subject for today, but I'm happy to talk about it in questions. I want to look more today at two key questions for macroprudential policy that we may face in the next stage of the crisis in relation to the banking system. First, whether the buffers of capital that were such a central part of the post-financial crisis banking reforms will prove usable, and if so, for what purpose? And second, how stress testing of the banking system, a key financial stability tool developed during the last crisis, should operate in an actual stress. On the first question, there has always, to be frank, been a little bit of a residual ambiguity about the primary motivation for the Basel III buffers. Were they intended to provide a safety margin on solvency so that banks could absorb losses without jeopardizing their regulatory capital minima? One might caricature this as the microprudential approach, or rather were they intended to provide space for banks to support the economy in a stress and avoid the overshoot of a credit crunch, which will deepen the recession and worsen the impact on banks? That could be caricatured as the macroprudential approach. Now, I've deliberately posed this question in extreme terms. The two motivations overlap to a large extent, and for most of the time, it's not really necessary to distinguish between them. But in the current crisis, with impairments in prospect, the impending withdrawal of government loan guarantee schemes, and great uncertainty about the future path of the economy, the potential tension between these approaches will come into sharper focus. To be clear, this is not and should never be about asking banks to weaken their underwriting standards. It's about the extent to which banks should lean against an increase in risk aversion as opposed to an increase in their risk. or to put it another way, to ensure that banks have the space within capital buffers, was to ensure that when banks have the space within capital buffers, they view credit decisions primarily through the lens of the borrower's balance sheet rather than primarily through the lens of their own balance sheet. This is not a call for altruistic behavior by banks. While increasing risk aversion and preserving capital to the maximum extent might appear the right approach for each bank in isolation, the collective impact of such an approach on the economy will increase losses for all banks. And the Bank of England did some analysis and modelling of this, which is public in our May financial stability report. These will not be easy judgments to make for banks or for supervisors. At the moment, banks in the UK are well above their capital buffers. But I suspect we will need to think through this question more as the recovery, albeit bumpy, gathers pace, as impairments mount, and as it becomes clearer how permanent the damage will be in different sectors of the economy. And we should ask ourselves now whether we've created disincentives in the regulatory framework to using buffers to support the economy. I have in mind here the first mover penalty for any bank to go into its capital buffer, and also the distribution restrictions that kick in when it does so. There are signs that these features of the system will make banks reluctant to use buffers. The bank has been working with other members of the Basel Committee on these issues. The committee has encouraged firms to make use of buffers and has committed to pursuing additional measures to achieve that if necessary. And of course, it's not just the view of the banks and supervisors that matters. The market will also take its own view on bank capital and bank solvency. We could perhaps learn from our experience with the counter-cyclical capital buffer, which has been lowered system-wide in a number of jurisdictions, freeing up capital headroom without first mover disadvantages or adverse market reaction. Long before this crisis, the Bank of England reached the conclusion that we needed to have a positive counter-cyclical buffer even when risks in the financial sector were not elevated, the so-called resting rate of the buffer. And we decided that in part because, exactly as has happened with COVID, a risk could crystallize very quickly. Last year, before the crisis struck, we decided to increase that resting rate to 2%. Looking to the future, we may want to revisit the balance between the various capital buffers with a view to having more in counter-cyclical buffers that are releasable by regulators and less in the fixed buffers. Finally, a few quick words on the lessons we're learning about stress testing of the banking system while you're actually in the stress period. The Bank of England, like other jurisdictions, uses stress tests to ensure that the banking sector is resilient to tail risk, to very severe but plausible stresses in the tail of the historical distribution. We have for some years now also adopted a counter-cyclical approach to stress testing, and the aim is to increase the severity of the stress as risk-taking builds up in the financial system, and to reduce the severity of the stress when risk-taking is subdued, as in the period following a major stress. But the current stress is posing the question about what you do when you're actually in the stress period itself. We're now clearly in the tail of the distribution of economic events. In the UK, the Q2 drop in GDP was the severest for 300 years. We're still arguing over whether 1706 or 1709 is the right comparator. But of course, we don't know whether we will go further into the tail of the distribution now, and if so, by how much. Given my earlier points about using the resilience we built up before the crisis to support the economy during the stress, it would be counterproductive to use the stress test to impose a tail event on top of a tail event and make banks capitalize to that level of risk. To do that would mean forcing banks into defensive actions just when such actions are counterproductive. But on the other hand, we do need to test and to communicate the banking sector's resilience to the more adverse COVID impacts and other plausible shocks that may be on the horizon. And the problem, of course, is compounded by the nature of this crisis, in which economic outcomes will be driven by very uncertain health outcomes, which will affect different parts of the economy in different ways. In such a stress, historical distributions of bank losses in previous recessions give us little guide to the probability and impact of further shocks. One way to address this problem is to construct severe and extremely adverse scenarios, such as those around a second wave of the virus and further national lockdowns of the sort we saw earlier this year. And many jurisdictions have adopted that approach. The problem is, in my view, is that a great amount then rests on the construction of these adverse scenarios, which are essentially informed guesses that probably now fall somewhere between the central case and true tail events. The Bank of England therefore adopted a reverse stress test approach in the summer. We looked to establish how much worse economic outcomes would need to be to deplete capital buffers by as much as in our pre-COVID 2019 stress test. The high-level answer was we'd need to see cumulative GDP losses of around £610 billion, nearly 30% of GDP, and twice as high as those in the Monetary Policy Committee's central economic case. And we'd need to see unemployment rising to 15%, leading to £120 billion of credit losses to deplete capital by as much as in that 2019 stress test. And even in that case, banks would use up only 60% of the buffers they now hold over minimum requirements. And based on that result, the Bank of England and the Financial Policy Committee was able to conclude that the UK banking system was resilient to a very wide range of economic outcomes, that, to go back to my first point, it had the capacity to use those buffers to support the economy, and finally, that it was in its own interest to do so. I'll stop there, Nicolas. Thank you.
Thank you so much. I see that we have a very knowledgeable audience today, and we already have questions, including a question from Andrew Sully on monetary policy and negative rates. I insist this is not the topic for today. We're looking at financial stability and macroprudential issues. So if you want to ask questions about negative rates, try to make them sound as if they're about the macroprudential and financial stability impact of that. Dan, you're on mute, Dan.
Yes, thank you. So first of all, let me say it's a pleasure to be back with my friend John Cunliffe, even if only virtually and separated by 3,500 miles. I'll try to say just three things, two of them directly responsive to what John said a moment ago, but I want to begin by emphasizing a topic that John noted, but then moved aside because he wanted to address some of the banking issues, and that is shadow banking, or if you prefer, non-bank intermediation. I would say that our experience in March and April underscored the fact that that is the truly unfinished agenda that followed the great financial crisis of 2007 to 2009. What John said about the banks in Britain is, I think, roughly paralleled by the experience of banks in the United States, although with perhaps some variants that I'll mention in a moment. But there's no question that elements of the non-bank sector were under severe stress, engaged in substantial amounts of fire sale activity, and were desperate for funding during that March and April period. Much of that intermediation activity reflected the classic and often toxic combination of leverage and short-term funding. The efforts both in the US and internationally on non-bank intermediation to date have proceeded in a kind of case-by-case basis. We take a look to see what are the risks in money market funds, what are the risks in non-bank financial companies. But that clearly has shown itself to be inadequate. The money market reforms didn't work anyway, at least those adopted in the United States. And we saw the activity that's been documented in the financial stability reports of the Bank of England, the Federal Reserve, the Bank for International Settlements, and those central banks around the world, which is to say, in hedge funds, in REITs, in non-money market bond funds, we saw outflows that seem to be accelerated or amplified based on the characteristics of the intermediation. And so I think going forward, we're just going to need to have a more comprehensive approach to non-bank financial intermediation, which doesn't regulate everyone, and certainly does not regulate most forms of intermediation in exactly the way that we regulate banks, but that does need to address these issues, because the alternative, quite frankly, is that John and his colleagues and Jay Powell and his colleagues will need again and again to be bailing out broad sectors of the economy which are not regulated, as opposed to the banks which are regulated. So now just a couple of quick comments on what John Cunliffe said. I agree that at some level, the regulators can force the buildup of buffers ex ante, but it's very hard to force the use of those buffers during the stress period, because oftentimes what happens is the effective regulator in normal times is the Bank of England or the Fed. The effective regulator in terms of putting constraints on banks in stress periods is the market, or can be the market, which is concerned about capital liquidity levels at the banks. I don't think we're there yet, and I hope we don't get there in either the UK or the US, precisely because of the post-GFC reforms. But it is a bit of a dilemma. Frankly, I don't think it's helped by allowing banks to continue to make capital distributions in the early stages of a financial crisis. I think actually it just makes the dilemma a little bit more tricky. On stress testing, my own view is that the highest and best use of stress testing is precisely at the onset of a major exogenously driven financial event. It is true that one still has to speculate there, but the speculation is considerably more informed than the speculation of a stress test in normal times, where you're really just making a guess about the event which may precipitate the problem. Here, at least, we know the etiology of the problem, and it's possible to develop scenarios that help you see what a, if not worst case, at least reasonably bad case outcome would be, and then approach the issue of bank capitalization, including capital distributions, accordingly with that information in mind. I think at a supervisory level, a parallel or simultaneous conducting of a reverse stress test would be a good complement to the more conventional approach. I also think an area that we, at least in the United States, have not really tackled effectively is how to value the assets of the institutions at the outset of the stress period. In normal times, market valuation, book valuation differences probably don't matter all that much for deciding capital levels, but it's precisely at the onset of a stress period where the book value of assets will frequently lag what the market value is. And if you do a stress test that takes losses against the aggregated market book value of the bank, you may be missing a substantial problem that the bank has. It's hard to do that in a systematic way on an ongoing basis, but I think, again, like reverse stress testing, it's something that needs to be incorporated into our crisis period stress test. With that, Nicolas, I'll turn it back to you.
Thanks so much. And we have, I have tons of questions. The audience already has tons of questions. And I think there are many follow-ups here. Let me start just with one point you alluded to, Dan, which is dividend distribution. Obviously, we saw both the European Central Bank and the Bank of England come up relatively early with recommendations or constraints on banks, which were greater than the one at the Fed, which only limited but didn't completely avert those distributions by US banks. John, what is your early experience of this? What do you think are lessons learned in this space in the last 6 months? And how do you look at it right now?
Okay, look, thanks, Nicolas. And maybe this goes to some of the things Dan was saying about the use of stress tests and how you estimate kind of the resilience of banks in an exogenous event and the like. I think in March, we were looking at a crisis that we didn't understand well. I'm not suggesting we understand the epidemiology particularly well now, and I've learned that epidemiologists disagree even more than economists, which is reassuring, I suppose. But when faced with a shock that you can't easily scope and a really wide range of uncertainty about health outcomes and public policy that will drive economics, my view was a sensible thing to do was to preserve capital and to get banks to preserve capital. To be clear, that was in excess of where the regulations say you should, where the automatic restrictions kick in. But to my mind, that was the right thing to do. As we get to know more about, I'll talk about Dan's points about stress testing later, that's about reasonable worst cases, or to look at it through the other end of the telescope, how much worse things would need to be to put the banks in certain positions. As you gain not 100% confidence, but more information about those things, I think you then have to go back and look at capital distribution restrictions in the light of what that's telling you. It's all part of the same problem. And to some extent, and I pose this as a question, not as a sort of policy direction, there is, and somebody's already said this in the chat box or the question box, and Dan mentioned it, the market matters and what the market thinks matters. Market at the moment doesn't seem to have an issue around bank capital and bank solvency, certainly in the UK. You look at CDS spreads, you look at the fact that banks have been issuing tier 2 and tier 3 debt at good prices in this oversubscribed. So there isn't an issue there at the moment. And when we dropped the counter-cyclical buffer in the UK, there was no market reaction, hardly any at all. But one of the reactions you may get to banks going into buffers is not people saying, I'm worried about solvency, because the buffers are pretty big. The reaction you may get is, I'm worried about distributions because of distribution restrictions. And that can act as a disincentive to bank management. And Dan is right. I mean, the natural inclination of many bank boards will be much higher risk aversion. And we can't solve that. We can't force banks to lend. But I think the messages we send and incentives like, if you go into buffers, you restrict dividends, we may have two policies here then that actually are working a little bit against each other. One is designed to use buffers to support the economy. The other is actually making it difficult for bank boards to do that. So where you put yourself in that dividends restriction really depends on what you think the health is of the banks and what you think the health of the economy and future risks are. I don't think it's the kind of never. It was a very different thing in March, of course, when we didn't know anything. And that was clearly the safest thing to do. But as we learn more, I think the problem becomes more of weighing up the pros and cons.
I have a question, a follow-up question on the buffers, because you mentioned, fixed variable, and we have a question on the Q&A from John Rega about this. Are you meaning that the capital conservation buffer should be reduced, or do you mean that there should be more emphasis on top of the capital conservation buffer on counter-cyclical buffers? And specifically, how do you think about the capital conservation buffer at all? Do you think of it as having been proven useless or having been untested so far?
So on your first question, Nicolas, I think you've got to start with some view also top down of what in kind of macroprudential and macroeconomic terms is the right level of capital for the banking system. So obviously at 100% capital, the banking system is pretty safe, but it's not going to do what you want the banking system to do. So I think there has to be all of these discussions about, do I want more or do I want different forms of capital, which is what you asked, has to be framed around that there is a point at which you stop increasing the overall level of capital. There has to be some kind of frame. And I think the Basel III, it was done. There was the MAG group, the macroeconomic analysis group, and others did try to do that calculation. It's not easy, but you at least have to have some frame of reference in your mind for where that level should be. And I think once you get to that point, that's a really difficult judgment to make. You then think about where is the best place to have the capital. And I think if you want to emphasize the safety margin over solvency, then it's things like the capital conservation buffer, which are hard to use, but provide that space. If you want to emphasize more the release of constraint in what could be an incipient credit crunch, then the macroprudential buffers are more useful. I think the first mover disadvantage of using capital buffers, which we're hearing more about now from banks, I think tends me to say I'd put more into the releasable. And bluntly, my own view is, yeah, I think I would look at the capital conservation buffer. We'll find out how usable it is. But I think if we came out of this crisis with banks taking defensive action to shrink their balance sheets, because that's what we're talking about, to deleverage, to shrink their balance sheets, just wide scale, to avoid entering the buffers, we might look back then at Basel III and say, well, was that really what we intended the buffers to achieve?
Do you see any evidence of credit scarcity right now?
No, and look, there's demand and there's supply, and
Exactly.
yeah, and there's a kind of demand issue. There are some areas where pricing has gone up, and you'd kind of expect that. Risk goes up, so compensation for risk should go up. And I don't think we've entered into a credit crunch now. Of course, most lending in many jurisdictions has been government guaranteed. So you could argue actually it's a form of fiscal policy with a contingent risk on the government balance sheet, and that's been much easier for banks to do. I think this will may become a more important question during the recovery than kind of during the initial phases. But at the moment, not. But as I say, there are government schemes in place, and demand for credit will probably have been affected as well.
But I think that's a very important point for that debate, that there is a possible concern about credit scarcity. It's not an observation on where we are now.
Correct.
And I think that also answers Jonas Niemeyer's question on the buffers. If it doesn't, I'll ask Jonas to ask another question to clarify what his additional concerns may be. Dan, on these issues of dividends and buffers, how do you look at the situation and especially the actions of the Fed?
Well, I thought I was disappointed that the Fed did not early on suspend capital distributions entirely in order to get its bearings and to make sure that it had a better understanding of what might happen before it allowed banks to proceed with any distributions. You know, I think John said a moment ago, as one gets further in, one may have a better sense of what the risks may be and to better calibrate whether one would want to allow capital distributions or not. This is a tough economic situation in which to do it because of the uncertainty as to how long the restrictions on the economy may go because of COVID. It's not, you know, you can't sit around the boardroom at the Fed and think, well, yeah, we're in this point of the recession right now, because the hit that you may take is, you know, as it's happened in France, and I guess this morning in Britain as well, some reimposition of restrictions. But you're still in better position if you try to do that early on and then move from there. The worst thing, I think, is to say, well, you know, right now our banks are well capitalized, so let's let them continue to distribute capital. But if things get worse later on, then we'll put some constraints on, because that's the point at which the buffer will have already been diminished, and the point at which, unlike today, markets might start asking questions about the banks. And it would be much harder at that point to get to the position that you want to be, which is the banks continuing to provide credit to creditworthy households and businesses. So I think that, as with my sense that the highest and best use of stress testing is early in an actual stress event, I think you initially is when the playbook would say you stop capital distributions until you feel you have a better handle on what the losses may be, and then you proceed from there, which could include relaxation if appropriate. But I think that with all the uncertainties and with all the shortcomings of stress testing, these are the tools that we've got. And until we have better ones, I think in an effort to preserve the credit intermediation function of the economy, you have to go in this direction. And by the way, if things turn out a lot better, then there'll be a lot more capital distributions down the road.
So I'll follow up on that because you've been a bit critical of the Fed. Obviously, you know what you're talking about. So let me ask questions that are related to this. One other thing that the Fed has done is exempting sovereign exposures of banks from some capital calculations, particularly the leverage ratio, which is supposed to encompass all assets. So I think there's a Basel guidance that allows authorities to exempt central bank reserves from the leverage ratio calculations, but that's a different proposition from holding government bonds, in that case treasuries, which are still viewed as reasonably safe, but obviously in other jurisdictions that may not be the case. So I've been concerned about that because I view it as a significant breach of Basel, but how do you look at this episode?
Well, I actually think, Nicolas, that the way the Fed did things, whether you agree or disagree with them as a policy matter, I think they're consistent with Basel. John will correct me if I'm wrong, but the move that was taken in the US was on the enhanced supplemental leverage ratio. I don't think any US bank will fall below the minimum, or it would be allowed to fall below the current Basel III minimum leverage ratio standard. So as a matter of international commitments, I think the Fed is fine. That's point one. Point two, look, I'm a believer in leverage ratio as a backup mode of capital regulation for a lot of reasons. And I think actually the 2007, 8, 9 crisis reinforced those beliefs. But I think we've also got to confront the fact that even now and over the next several years, the reserves held by banks, and very likely the sovereign bonds held by banks, they're going to continue to go up. And that's the other side of the fiscal stimulus that many people, including I think all of the Fed and I, believe is necessary in order to get the economy back on a better track. That being the case, we're going to have to rethink the impact of reserves for sure, and quite possibly sovereigns on the leverage ratio. You know, you might take the approach that the Bank of England pioneered a few years ago with saying, okay, we're going to exclude reserves, but we're going to have a higher leverage ratio for the remaining assets on the balance sheet. I'm not sure 25 basis points was as much as I would have done it, but it was the right idea for sure. Another option would be to increase the risk-weighted capital requirement, for example, through the GSIB surcharge. But one way or another, whether you're a believer in leverage ratios, or you're a skeptic of leverage ratios, those are going to have to be confronted. You're right, Nicolas, that the treasuries pose a different issue, because even if you believe that full faith and credit of the United States still means full faith and credit, and it'll be just fine as a credit matter, they're still subject to market fluctuation. And you know, when you look at the trading book requirements for capital right now, that there is risk associated with treasuries because interest rates can change and so you can lose money. So that it's a little harder proposition, but I think that's a proposition that's going to have to be thought through in the context of very large fiscal deficits, no matter who wins on November 3rd in the United States, and I suspect in many other countries in the world.
Obviously, as somebody who comes from the Eurozone, I'm very sensitive to the distinction between central bank reserves and sovereign exposures, which I acknowledge has particular salience in the supranational monetary union. But my understanding had been that the Fed decision was technically in breach of Basel III. John, can you enlighten us on this?
So the Fed decision to take treasuries out of the leverage ratio, which I think is temporary, isn't it? It runs until March of next year. I'd have to check, Nicolas, to see whether it is or it isn't. I think more interesting question in a way is, I think you have to look at the dash for cash and what happened to US treasuries. I hate to use the word, but it has to be holistic. So the way central banks provide liquidity into the system is through the wholesale banks. Okay, we've now created a system in which people hold large amounts of so-called high-quality liquid assets, to use in stress and to be able to kind of monetize when they need to. And the question is really, the non-bank sector has grown really very considerably over the last 10 or 15 years, and the US Treasury market has grown hugely. So even if you think it's the leverage ratio that's constraining wholesale banks, actually the ability of the market makers to hold that proportion of inventory to the amount of US Treasuries out there has got much more. Darryl Duffy's published some interesting work on this. So I think a question for central banks and for regulators is, when we see a market stress, do we actually have the machinery to get liquidity to the parts of the market that are in stress? And then I think you come to Dan's question, well, why are they in stress? And are they in stress because of amplification mechanisms within their own structures? And if they actually want access to liquidity, that goes along with, it's a bit of a bargain here, with ways of reducing or eliminating those amplification mechanisms. Or are they in stress because they actually have provided the liquidity or stored it up in terms of HQLA, but actually can't liquidate it because of the banking system? And I wouldn't want to solve that problem just by saying, well, we got to remove leverage ratio constraints on the banks as far as government bonds are concerned. That, to my mind, seems to be just to be transferring risk from one area to another, so robbing Peter to pay Paul. I think you need to look at how central banks put liquidity into the market, but you also need to look at the regulation of the non-bank sector at the same time and try and act on kind of all parts of the problem. On central bank reserves, we did calculate the 25 basis points as being the actual offset at the time. We may have got it wrong, but I think for central bank reserves, they are different. And you may well find that monetary policy is frustrated by the leverage ratio for that reason. One last point, there's got to be a better way for central banks. If the purpose is to get liquidity into the financial system, there needs to be a better way than by putting huge amounts on our balance sheets, which stay there for a long time and are difficult to move. So if that's the problem we're trying to solve, I'm not sure we've got the right mechanism to solve it.
I have another question which will help us pivot to the non-bank sector. Mark Sobel is asking you, Dan, about FSOC, and what's your view of FSOC so far? Is it working? So FSOC, of course, being the Financial Stability Oversight Committee, I hope I get the acronym right, which is chaired by the US Treasury, was put in place by the Dodd-Frank Act, and has gone through different cycles during the Obama and the Trump administrations.
Well, I mean, I think there are two kinds of questions there. One is sort of institutional and structural, and one is contingent based on who's in office or power at any one time. I think pretty clearly over the last several years, the leadership of FSOC hasn't been interested in putting any new regulations into place. And so it doesn't matter what your structure is, you're not going to get anything out of that. We've seen some of the impact of that with some of the things that have been discussed over time not having been addressed, contributing to the problems in March and April. On the structural issues, I guess the UK clearly has a better approach in the Financial Policy Committee, but I don't think that's really transferable to the United States. I mean, you have to think about the overall structure and constitutional organization of government. And I think to date, at least, the FPC has acquitted itself quite well. It doesn't have quite plenary powers, but it has pretty broad authorities. And the way that it's connected to the Bank of England means that there's coordination, but the bank is not omnipotent, which is probably the right way to structure as well. But in the US, we're not going to be able to replicate that, I don't think, precisely because of the number of independent regulatory agencies we have. I do think that there is an issue with the Treasury Secretary being the chair of FSOC. It was very important in the wake of the crisis that finance ministers, treasuries be involved closely because you needed the oomph from the entire government to get reform going. But in normal times, in normal times, there's going to be two kinds of instincts when the Treasury chairs FSOC. One is, at least at the margin, we kind of want to lean towards near-term economic growth rather than long-term financial stability considerations because we've got elections coming up. And secondly, it's just, it's an irresistible temptation to not bring part of the administration's own agenda into the FSOC. That is not a financial stability issue, but something kind of related to the financial system. And so in those two senses, I think that with the limitations we've got, because the chair of the SEC cannot authoritatively speak for all 5 members in the FSOC, much less take action.
You mean all 5 members of the SEC? You mean?
Sorry?
You said all 5 members of the SEC. I think you mean of the SEC.
The SEC, sorry, that's right. Yeah, even though that can't happen, I think if the FSOC were chaired either by the Fed, which was one proposal, I think that was Sheila's proposal, or if it had an independent chair with a staff, something like that, I think you might get a little bit more financial stability focus, but it still wouldn't fill the gap either legally or I think institutionally that exists between us and the UK right now.
So maybe that's a good point to pivot on the whole issue of non-bank intermediaries. You mentioned the SEC, which obviously has a lot of roles in that space. We got a number of questions from Victor Baker, from John Rega, from Don Cohn, from Richard Portes on the Q&A on this. So let's get a bit specific. What would you do on funds, money market funds, non-bank intermediation, beyond saying they should be regulated? What kind of, and I think you mentioned that they shouldn't be regulated exactly like banks. So what kind of framework do you have in mind? Is it too early to tell? Or do we know more or less what should be done in this category? Dan?
I don't think it's an easy question. It wasn't for want of thought that the FSB 7-8 years ago failed to come up with a kind of comprehensive principle approach to all forms of non-bank intermediation. There were ideas about that, but the ideas tended to reduce to comparisons with waterfowls. That is, does the quack like a duck, walk like a duck get you close enough? And that falls a little bit short of the analytic rigor that we want before we actually start imposing regulations. And so that's, I think, why the FSB and many governments around the world, including the US government, fell into the let's take things case by case. When I say I don't think you can do that, I think we're going to have to try harder now to come up with some principles that identify forms of leveraged intermediation, particularly where the funding is significantly short term. And take an approach, for example, through margining, minimum margining requirements that are generally applicable. I'd say on the money market funds, look, seriously, how many times is the United States government going to have to bail out money market funds? At a minimum, I would say you'd have to go to floating rate for all money market funds. And even then, you may need to do more. It may get to the underlying problems with the CP market as well. I think money market funds are a bit of a special case because the sort of cash alternative value of money market funds is so strong. And of course, you're allowing entities to create cash, and then it turns out it's not really cash and stress. I would say that it's that the identification of the points of intermediation where you can regulate transactions rather than always regulating entities. And that's why, for example, in the securities financing transactions, the repo market, that's a good place to have a set of minimum margining requirements. Indeed, we negotiated something like that in the FSB, but it hasn't been implemented, I don't think, by any country.
John?
Look, first, I endorse very much Dan's points about these difficult questions, and anything we do has got to be based on evidence and analysis. And this is a very disparate set of actors in non-bank finance. It's a much harder problem to get your arms around than the banking system. And of course, prudential regulators knew a lot about the banking system because they regulated it. They don't know that much about this universe. And just porting across bank regulation to markets, that's the reason why the FSB stopped. It didn't make sense to do that. And I think that's right. That said, I think there are some generic type issues that you need to look at. So first is this question of, and it's really a question of liquidity, not solvency, but it's a question of whether the nature of the underlying assets, how liquid they are in terms of stress, the nature of the redemption promise, and the tools available actually make sense for a particular strategy. And that could be a money market fund or an open-ended kind of investment fund specializing in equities. I think you need to look at those three things together. So it may well be that the fund is invested in very liquid assets, in big lit markets. It gives a daily redemption promise, and then it's got mechanisms like swing pricing, if necessary, to deal with certain things. It may be, and somebody put it in the chat box, you're dealing with open-ended real estate funds where it takes over a year probably to sell an asset, and you can't establish the value of an asset in a crisis, and there you would want to do something different. But I think one needs to look at, generally for the whole spectrum of funds, you need to look at their open-endedness, if I can put it that way, their redemption terms, their underlying assets, and the tools they have. And you may need to balance something. In some cases, you may need to say, you know, it's a 2 or 3 month redemption period because of the nature of the underlying assets. One of the things I think we saw, not trying to preempt the analysis, but I think we saw in March was people selling equities because they couldn't sell bonds. And one of the other things we saw was open-ended funds acting kind of more pro-cyclically than other areas. I think because fund managers wanted to go to cash for precautionary reasons, maybe for opportunistic reasons. But of course, to get there, if you can't sell the bonds because the markets are dealer intermediated markets, then you move into equities. I think we saw some rebalancing back from equities to bonds, bonds to equities in June. That's part of the reason for stock markets. So I'd look at that nexus of issues. I think money market funds are a particular variant of that problem, which is that people treat these things as cash when they are near cash. And if you are holding something which you think is cash for use in a stress, and you discover in a stress that it isn't cash, actually, you know, it can't pay out past a certain point, then that's a vulnerability in the system. The rules on money market funds are very different in the European Union than in the US. We don't have the kind of prime government distinction, and we have different forms of variable asset, variable value funds. But I think in general, one needs to look at whether there's a vulnerability in the system. If people have something which they believe is a bank deposit account, and they can use as a bank deposit account, but under stress is not usable in that way. And you know, 2 strikes, you know, is enough, I think, before we look again at that question. Do you want me to say something about margin? Because I can then, you think one of the things we should look at, and I noticed there was some questions on that. Yeah, so just on margin, look, I am really firmly of the view that clearing by central counterparties and margining is a huge improvement over what we had before the financial crisis. And when people talk about the impact of margin call, you know, during the crisis, if we weren't able to net margin across the system and we just had bilateral margining, I think the gross flows would have been much, much greater. So I think we avoided the emergence of counterparty credit risk big time, partly because of the margining, etc. It's axiomatic that if you have protection against the movement in asset prices, that protection is going to increase when asset prices move very sharply. For me, though, it is kind of two questions. One, did margin move by more than it needed to? And this is more a question of, for those who follow this, initial margin than variation margin, which just follows the movement of asset prices. And can there be ways of dampening the movement in margin under stress to make it less pro-cyclical? It'll inevitably go with the cycle because it's protection against asset price movements. And the second question is, were market participants prepared for stressed margin call and what that could do? So I'm thinking now in terms of, severe but plausible events. Do people actually understand what happens to margin in a stress, and do they provide for it, or do they not? And if they have provided for it, and you could argue that some did, can they then turn the assets they're holding for liquidity into liquidity, which goes back to my, can you convert HQLA in a stress? And finally, on Dan's point, I think the two most explosive things to do are to take a bet on market moves, even an apparently completely safe bet, with leverage. Because when things start to move against you in extreme events, the leverage really hits you and the margin call really hits you. And some of those fund strategies, hedge fund strategies, I think need to be looked at to make sure that's not the issue we're facing. And if it is, it's great to have people who arbitrage between the cash market and the derivative market in good times, but not if the cost of that is a really big vulnerability in stress times.
Very interesting. On money market funds, I noticed that you said we, referring to the context of the European Union for that matter, which I take as a hopeful sign for future relationships.
I refer you to the Withdrawal Act, which onshored European legislation.
Absolutely. And there's a question from Caroline Atkinson, which is if you can clarify the difference between the MMF's money market funds as a US issue and how it plays out in the EU or in the single market. Yeah.
So I think the US issue was in the prime money market funds and the distinction between prime and government. I think that in both cases there are rules around liquidity and gates and the like. And what the US saw was a movement from prime into government. But even then, to support prime, the US, the Fed, had to have the money market fund facility to encourage banks to be able to make a market in the underlying assets and the like. On the European side, there are government bond funds, but the majority of funds fall into the variable value or low volatility, LNAV. I'm trying to think of what the acronym stands for. You gave me an injunction to spell out acronyms before this started, Nicolas, and I can't remember but basically the low volatility funds, which have liquidity buffers, but where the value of the fund can't depart from the value of the underlying by more than a certain amount. And those funds, I think, were designed to kind of find a compromise point between kind of variable value and constant value funds. I think what we saw in the crisis was, and again, we'll need to look at the evidence, and there are many in the industry who say this wasn't the case, so this needs to be explored. But what we saw in the crisis was those funds seemed to approach their liquidity limits, and then the prospect of gating was there. And actually, when you're in a systemic dash for cash, effectively a crisis, the last thing you want is one money market fund suspending, gating, or taking action because it's hit its regulatory limits, because at that point you worry about sparking this across the market and contagion. And I think that contagion impact was similar concern was similar in the US. It goes back to the thing is, are things which people treat like a deposit account or want to treat as a deposit account in stress actually a good idea if they can't function in that way?
Right. Unfortunately, we're already at our time limit, and as has been the case in the best sessions of the series, there's a million things we haven't done. There's a million questions we haven't answered. Very good questions from Jose Maria Roldan, Tim Clausen, Jacqueline Mills, Stephen Kang, Stephen Schmidt, Maurizio Trapanese, and others. They're all on the Q&A. They will be for further reflection, but I want to thank very warmly John Cunliffe and Dan Tarullo for what I think was a very substantial exchange. We will continue this conversation because there are so many big issues for regulators here. I cannot announce with certainty the next session because we had a little glitch in our planning, so I'm not sure we'll have a session in late October. But we certainly will have one which you can already mark on November 9 to celebrate the 6 years of operation of the single supervisory mechanism with Andrea Enria, who is the chair of the supervisory board at the ECB there. And that happens to be November 9, the birthday of Jean Monnet, which is a coincidence. So thanks very much, John. Thanks very much, Dan. And thanks again to all in the audience for participating in financial statements at the Peterson Institute. Have a great rest of your day.
Okay, thank you.
Thank you.
Good to see you there.